Good morning from London. I'm Anna Edwards alongside Guy Johnson and Lizzy Burden. We're an hour away from the opening trade. Here's what you need to know. European and US futures dipped slightly as earnings season kicked into gear on both sides of the Atlantic, with companies weighing trade uncertainty against broader market concerns. But the trade turmoil continues to impact bond markets, with treasuries rising for the fourth day ahead of the August 1st deadline, while Japanese markets still assess the impact of the latest elections. Plus, Treasury Secretary Scott Bessent keeps the pressure on Jay Powell, calling for a review of the Fed's building renovations.
Well, it is eerily calm out there. The S&P hitting another fresh record yesterday, topping that 6,300 level yesterday. But look, it hasn't had a move in a day of more than 1% up and down all month so far this July. And at the moment, futures are pointing lower. This rally is narrow. What we've really been waiting for is the result in the market of that Japanese election, belated as it is. But the relief rally on the Nikkei and on the yen, pretty short-lived, it would seem. The countdown to the opening trade starts right now.
Tuesday morning, good morning. The Teflon market is still firmly with us. Lizzy was just running us through the details of what is happening in the markets right now. Nothing sticks to this market, certainly not bad news. Look at what is happening with the VIX. We're at 16, just north of 16. You've got stocks, US stocks at fresh record highs. You've got this period of calm. Meme stocks are back. Who would have thought that? I'll show you some names in just a moment. There's a few that really stand out. Open Door Technology is certainly one of them. The earning expectation story looks pretty good. Nothing sticks to this market. Nobody's worried about, seriously, Powell getting fired. That seems to be the narrative, judging by my inbox and all the notes that I'm getting at the moment. And everybody seems to believe that the Europeans are going to get a trade deal. Don't worry about tariffs. All good. VIX is at 16. Nothing sticks to this market. Rally on.
Yeah, that's one interpretation.
Yep.
Full belief in the taco trade, that there is some kind of Trump put, and that if stocks really fell out of bed, that he would be back to change policy. And there we go, happy days into the second half of the year. And we've heard that view on this show, not in those words exactly, we've heard that view on this show. Mark Cudmore pointing out to us last week that, you know, there are the other side of the argument is that people are saying, look, the average tariff rate in the US is going to be substantially higher than it was. But we don't know what it is, but it's going to be substantial. And that's not priced in. And at some point, surely that has to stick. And that has to be.
I've heard that narrative for ages.
I know.
Yeah, but Cudmore saying that it has to be August the 1st. There has to be a cliff edge at some point because Trumponomics has to find a way of paying for itself. You need the tariff revenue to pay for the tax cuts at some stage. But as you say, Guy, this market just not believing it at the moment, including some of the big asset managers, Fidelity, Invesco, JPAM. We're going to get Hugh Gimber on later on. Is he going to be making that argument that, you know, we are overestimating the impact on margins, we are overestimating the impact on earnings, and the tailwind of the weaker dollar as well?
It's interesting, though, the stocks, yes, climb this wall of worry, if it even is a wall of worry. They climb anyway. But bond markets are a different thing, aren't they? And we've had 4 days of treasuries rising and yields coming down. And Europe, yesterday, we saw French and Italian yields dropping 10 basis points in the session. And a lot of people are citing that August 1st tariff deadline and saying that this is a bit of a move into perceived safety of bonds ahead of an August 1st deadline. But you're not seeing the other side of that, which would be stocks selling off.
No, and also you could argue that lower bond yields, you could argue that tariffs are inflationary. They're inflationary in the United States, maybe they're disinflationary elsewhere, and maybe that's why European markets are pricing in and doing what they're doing, which is a difference between the Treasury market and the European govies. So maybe that's where the difference lies. But yeah, maybe bond markets are sort of sending a slightly different message. Yeah. But it's not that different a message, and we've had a look at 5, haven't really got through that. Markets, the bond yields have come back down again. We're still in a reasonably benign environment. Believe you me, there are lots of things in the back of my head going, yeah, what about this? What about this? What about this? What about this? But the market, I come back to this Teflon argument, just slides off the market. Nothing sticks at this point.
What about earnings?
Well, yeah, so it's FOMO for now in the markets. When you look at the tariff impact on earnings, it's barely there. We've had a load coming out this morning. Let me run you through them. We've got Akzo Nobel coming out, of course, the Dutch paint maker, makes Dulux. They're cutting their profit forecast. Not much mention of tariffs at all, but citing reflecting the macro uncertainty. You have Givaudan, the Swiss fragrance and flavour maker. They met their estimates for the first half. They say the tariff-related impact remains uncertain. So that's a theme, isn't it? You've got Lindt, the Swiss chocolate maker, saying that the consumer sentiment in North America is weaker. That's interesting. But no direct mention of tariffs. And then Norsk Hydro as well. They don't have that much direct exposure to tariffs, but beating estimates for the second quarter adjusted EBITDA.
Yeah, I think the aluminium story is that they do have some exposure into what is happening in the metals market. I take a slightly different view in terms of what I think we are hearing from some of the commentary that we're getting through from companies this morning. And it's not the tariff story, it's just the inflation story,
yes,
which I think is there. And you can see that kind of acts in a bell. Higher pricing and cost reductions compensated for lower volumes and inflation. You've got Givaudan increasing in input costs at a group level, now expected to be circa 3%. That's not high inflation, but it is inflation coming through. Lindt, cocoa prices remain high, really quite high. Food prices generally are reasonably elevated as well. Now, they're saying they can partly compensate for higher chocolate prices. Believe you me, my wife's paying a great deal of attention to that. Chocolate prices are definitely higher, particularly of the Dubai variety. Dubai chocolate? What was all that about?
I have no idea. But prices generally of chocolate.
Yeah.
But that, to your point, this is a sector that clearly has pricing power because we see the prices rising in front of our eyes.
Inelastic demand.
Go to a
perhaps.
supermarket and look at what... every week, prices seem to be rising. I continue to see food prices rising.
Yeah.
It's not just in chocolate, it's everywhere. Cameron Crise was writing about this yesterday, a 30% rise in butter prices. We're just seeing...
The new eggs.
Precisely. There are price rises coming through into the system. So, yes, I don't think there's much tariff mention here.
Yes.
There's a lot of inflation mention.
And where there is no tariff mention, to your point, Lizzie, about uncertainty, it does seem that businesses are finding a lot of euphemistic ways to talk about tariffs without mentioning the T word, aren't they? There's a lot of mention of geopolitical uncertainty, macro dynamics and headwinds and all of that sort of thing. Yes, I certainly saw increased uncertainty cited by Norsk Hydro this morning. Let's move on to a running theme on the programme, has been for weeks and weeks, hasn't it? And that's attacks by the Trump administration on the Federal Reserve, on Jerome Powell. Now, the latest one of these takes an interesting turn. We've heard from Scott Bessent yesterday and then in social media posting overnight. He's calling on the Fed to do two things: review the decision around renovations at the Fed headquarters and review all the non-monetary policy activities. Has there been mission creep? Do they jeopardise the core monetary policy goal? Now, I'm interested in some of the detail here. It ties into the wider attacks on the Fed around the renovations that we've seen the Trump administration jumping on. But what is really interesting, and I think the Fed put out a video of some of the renovations, which does show some of the scale of what is being attempted there at the Federal Reserve. But as our producer pointed out earlier on, it's interesting to put these Bessent comments in the light of weekend reports that had suggested that it was Bessent who was going to go to Jerome Powell's defence, and Bessent who was going to try and save Jerome Powell. That was what a lot of the US media were talking about over the weekend. And so maybe he feels for the MAGA audience he needs to counter with something that sounds a little different.
Well, it comes back to your point, Guy. You're saying, the market doesn't believe that Trump would get rid of Powell. And we were meant to be encouraged that at least Bessent would be there to save him. At least he would be the voice of reason. But he's kind of knocking that here by showing, I could be a threat to
you would have to have such a solid case to get rid of him. The Supreme Court made it very clear that getting rid of Powell would be very, very difficult. And you do wonder whether the market believes that this is really going anywhere or whether this is noise associated with all the other things that are going on out there at the moment. The latest one that's in my inbox this morning from Libby Cantrill over at PIMCO, Washington Watch, why we do not think President Trump will fire Federal Reserve Chairman Powell. There's note after note after note. The market, again, just coming back to this idea, yes, this is a risk, but do we need to take this risk that seriously?
Basically, they're stoking the risk. They're keeping it alive all the way till the end of Powell's term. Does this keep a lid on that rebound in the dollar that we have seen?
Perhaps when they don't like where the news agenda is going that particular day, when they don't like the stories that the media are picking up on, there are others that are available. Should we talk about banks, Guy? We've had some news from European banks.
UniCredit, there's a couple of things going on. There's two kind of long-running sagas. They feel like they're long-running sagas. Anything more than a week is a long-running saga. UniCredit is one of them. UniCredit may increase its stake in Commerzbank to 28%. I thought that had gone away. I'd completely forgotten about what was happening between UniCredit and Commerzbank. I can't remember where the stake was, though, in terms of where they built it up and how they built it up. Right. There you go. So actually, that's quite a meaningful jump potentially coming through. And we've also got some news relating to BBVA, and it looks like they're going to push out the Sabadell story a little bit further, Anna, to maybe into the autumn.
Yes, exactly. So on the subject of Spanish banking consolidation, and let's remember, sometimes within borders, it's hard enough to put these banks together, let alone between them. So BBVA delaying the filing of its Sabadell bid prospectus to September. This is according to Expansión over in Spain. So we'll continue to watch the Spanish banking story and see how that develops.
Who we got on the show? Let's talk about it. We've got some great guests lined up. Bilal, Hafeez, Macro Hive CEO, is going to be joining us. He was on the show, last time he was on the show, 140 was his call on euro dollar.
That was a
I
headline.
remember you had to clarify that you were at 114 on that particular day.
Yeah.
Anyway.
Check we weren't talking about dollar yen.
We'll come back to that story. Hugh Gimber, JP Morgan Asset Management. Lizzie was mentioning him a moment ago. Global Market Strategy is going to be joining us. Peter Kinsella is going to be joining us from UBP as well. Forex Strategy. We'll talk about what is happening with these euro levels, and we'll talk more about what is happening with the yen, Lizzie, as well.
Yeah, coming up on the day, but we have at 10 a.m. London time, the Bank of England's Governor Andrew Bailey testifying on financial stability. Then it's a pretty data-light week stateside, but with big focus on US earnings. And so before the market open, we get GM and Coca-Cola. Maybe we'll get a bit more detail on President Trump's comment on the switch from corn syrup to Coke.
He has views. Yes.
Over at Coca-Cola. Then at 3 p.m. London time, it's US new home sales. And then we have lots of European earnings as well. ASM International and SAP coming after the bell.
I think it's so the European earnings story, I think, really gets into gear later on this evening. I think it's 9 p.m. that SAP is going to be dropping, but names like LVMH are out on Thursday. So I think you're going to get we certainly gain a lot of traction as we work our way through this week. What else do you need to know? What is it? This Tuesday morning, UK retailers are renewing efforts to persuade Chancellor Rachel Reeves to bring back tax-free shopping for tourists. According to the Association of International Retail, making purchases exempt from VAT, value-added tax, could result in a £3.65 billion addition to spending by visitors from the EU alone. AstraZeneca says it plans to invest $50 billion in the United States before 2030. The UK drug giant is the latest European pharma company to ratchet up spending in the US ahead of potential tariffs on imported medicines. Some people are talking about 100% on those tariffs. The investment will go towards manufacturing as well as research and development, including a $4 billion facility in Virginia that will make drugs for chronic diseases. And officials and cybersecurity researchers say that hackers have exploited a flaw in Microsoft software, breaching government, business and organizations worldwide. Microsoft released a patch over the weekend, but is warning more fixes are coming as attackers continue to target SharePoint clients. The vulnerabilities were first identified in May by researchers at a Berlin cybersecurity conference.
Coming up on the programme, a chocolate maker Lindt and Sprungli puts its faith in the US consumer, boosting its full-year guidance. We will check in on the share price as that stock opens. Plus, as European leaders head to Asia, talks with China and Japan could shed light on Europe's position in current trade negotiations. Up next, markets have put tariff concerns perhaps on the back burner for now. How long will that last? We will discuss. If you have questions, if you want to get involved in any of these conversations around this desk, the sun is up in London this Tuesday, the 22nd of July. Please do get in touch. IB plus BBTV Go is the function to use on the Bloomberg terminal. This is Bloomberg. Welcome back. 16 minutes past 7 here in London. So around 45 minutes until we get the start of European equity trading. And it seemed that we lost momentum, even if we did well in the US to some degree. We lost a little bit of momentum during the session yesterday. And so perhaps we need to factor some of that into our European trade today. US stocks have extended their record high ahead of a key week of earnings. Let's bring in Bloomberg's Valerie Titel, who is with us this morning. Valerie, good morning.
Good morning, Anna. Yes, the S&P 500 closed above 6,300 for the first time yesterday, notching its 14th record high of the year. We're now up 26% since the lows of April. Now, that's the good news. The bad news is that the breadth still isn't that healthy. Only around 8% of S&P 500 stocks are trading around their one-year high. But I, for one, was very shocked to see that we've gone nearly a month without a plus or minus 1% swing in the equity market. So it's really been the dampening of volatility that's helped notch these record highs. I guess we've gotten really addicted to the fun from the earlier in the year, but this volatility has continued to stay pretty sanguine, helping this equity market out. There has been a turnaround when it comes to those more frothy stocks of late, maybe pointing to the fact that another record high or heading substantially higher from here might be a bit hard. This is a chart of frothy stocks. This white line is the S&P 500. These colorful ones are things like non-profitable tech, SPACs, Bitcoin-sensitive stocks, even retail stocks. Those did not perform very well yesterday, showing that maybe this equity rally might have a bit more difficulty continuing this streak of record gains. And to that, guys, maybe the main story is going to be now the kind of tariff news that we get out of some of these earnings that we do get. We do get a lot of autos coming in the next few days. The first one is GM that's hitting before the bell today. Next, we move on to Tesla tomorrow. On Friday, we get Volkswagen out of Germany, and early next week is Ford. So very interesting to see how these companies are already dealing with these tariffs that are in place and whether their margins are taking a hit or whether they're doing pretty well, being resilient and changing their business model to get around tariffs. Guy.
I'm going to Wolfsburg on Friday. Really looking forward to that. I really want to hear what VW has to say on all of this. Valerie, thank you very much indeed. Let's kick this around a little bit more. Bilal, Hafeez, CEO of Macro Hive, joining us around the table. Good morning.
Morning.
This is like a Teflon market. Nothing sticks. I've got low volatility, tariff risk. What tariff risk? Yeah, it's out there somewhere, but it's not going to have a meaningful impact, despite what the corporates are saying. You've got Fed risk. Yeah, but do I really need to worry about that? Nothing is... Why is nothing sticking?
I think a few reasons. One is that investors have generally been quite cautious. So to some extent, you could say people haven't been as well positioned. And then stocks have performed incredibly well.
Yep.
And part of that is if you look at earnings that we've had so far, they've been really, really strong. And people were really fearful that tariffs would blow up margins and so on. No one's really talked about that, at least not directly. So for that reason, I think, we've seen this resurgence in the S&P particularly and stocks more generally. And the other factor also is that yields generally have been fairly well contained. So if you're in an environment where global yields are low, financial conditions are easy, while the Fed hasn't cut rates, everyone's expecting them to cut rates. And so you're in this environment that's very positive for risk.
So even if we get to August the 1st or August the 6th or whatever it's going to be, I don't know exactly when this is all going to hit, but say tariffs do go higher and there's a dip, do you just buy it? Is the same narrative, is the same muscle memory still in action as it's been for the last few years? Any dip, buy it. Any opportunity, take it. That seems to be the narrative, and it continues to be.
Well, I think that is the narrative, but I think we are in a different paradigm now. So I think that people are underpricing the risk of tariffs. One issue with tariffs is that we've been talking about tariff risk. It hasn't materialized, so people are getting bored of that. But it's a slow burn. It's acting in the background. And August 1st, we'll see another ramp up in tariffs. And the effective tariff rate for the US is around 20% right now. It could go up to 25, 30. Then it'll start to sort of slowly work its way through the broader economy. And if you look at the performance of stocks right now, the best performing stocks are the sort of tech, service-related, non-tariff impacted ones. The broader indices like the Russell 2000, small caps, they're not at their highs. Even the equally weighted S&P is not necessarily at its highs either. So it gives you some sort of sense that tariffs are working their way through the system.
Is the market also underpricing the risk that Trump ousts Powell?
I think that is that risk. I mean, at the moment, the issue with that story is that the first reaction of the market to Trump ousting Powell is a Fed cut, which the market views as positive, and it's less about the credibility of the Fed. So if you looked at the times Trump has directly attacked Powell, the market initially has the rates rally initially. Longer term, it's going to be a huge problem if he does do that. And I think that the initial reaction of the market may be the wrong reaction.
Am I going to be the one as well, though, to bring up your call?
She's going to. How many times have we seen Bilal Hafeez on Bloomberg Air?
You're not watching Bloomberg if you haven't seen this. 140, you said. I'm going to remind you, Bilal, the next 1 to 2 years for euro dollar. Let me just see where we are right now.
You still got time then.
Still got time, yes. Absolutely.
But how much does the threat to Powell, the lingering threat to Powell, keep a cap on dollar strength?
I think that is a factor, for sure, and it works with two ways. This constant pressure on Powell, at some point he will capitulate and cut rates, which will hurt the dollar. But the longer-term issue is on the credibility of the Fed. So if we see all of these direct, indirect attacks on the Fed, the Fed will lose credibility, term premium will go up. Already, if you look at long-term US interest rates, the 30-year, it's close to its highs. So it's telling you markets are worried about the US in some dimension. So that will, play into our view that euro will go to 140.
And is the attacks on the Fed and attacks on various US institutions, is that leading to more interest in alternative currencies, stable coins and the like? Is there a link between those two dynamics, Bilal?
I think there is a kind of a weak link between the two. Credibility of the dollar, more move towards Bitcoin and stablecoin, and we've sort of written a lot about stablecoin recently. But the bigger factor really for stablecoin and Bitcoin is really the deregulation or the pro crypto stance of the Trump administration more than anything else. It's less to do with people worried about the dollar. It's more to do with the US administration is more favorable towards crypto.
And you've done a lot of work, as you say, on stable coins. And I was interested in what you had to say about the link with Treasury bills. So you say that because a lot of them are going to be backed by Treasury bills, that the more we see the emergence of stable coins, the more we're going to see more demand for Treasury bills. Does that influence where the government starts to issue then? Are they going to be issuing more at the shorter end for other reasons perhaps as well? But if this is going to drive demand at the short end? Yeah,
I think that there may be a motivation for pushing stablecoin as an additional driver of demand for treasuries in general. So it's quite convenient that you have this huge interest in stablecoin and stablecoin has to buy treasuries. The problem is they're mainly holding T-bills, short-term sort of debt. And what the US needs is people to buy coupon, longer-term debt. And so that doesn't solve the fundamental problem that you have to get someone to buy longer-term debt. Otherwise, you have to keep rolling these T-bills. So the government at the moment will just issue lots of T-bills to try to mitigate this. But in the long run, this won't be a sustainable solution.
Isn't it just a zero-sum game, though? If I was a buyer of Treasury bills, I'm now a buyer of stablecoins. A stablecoin is in some ways just a proxy T-bill, isn't it? In some ways. It has more uses if you're in the crypto market. But why does demand necessarily go up significantly because of stablecoins?
Yeah, it's a great question. I think fundamentally it's because the types of people that buy stablecoin are not the same buyers as T-bills.
Right.
And the fundamental reason for that is the stablecoin buyers are mainly crypto investors who would normally buy Bitcoin, Ethereum. They might buy like meme stocks.
Buying it as somewhere to park their money while effectively it's a safe haven
within the crypto system. Yeah. And the other fundamental difference is when you buy a T-bill, you earn the interest on the T-bill. When you buy stablecoin, you don't earn interest, which I don't think investors quite appreciate.
And we just had these Leeds reforms from the UK Chancellor, and she's talking about wanting to be a leader in fintech globally. Does the caution that you're hearing from the UK when it comes to crypto kind of look like the UK is going to be in the dust a bit here, not in line with what Reeves is saying?
Correct, yeah. I think on the fintech side, there's really two directions you can go in. One is the crypto route, which I think the UK has been left behind in compared to the US. And to some extent, the US will always be the leader in this space. The other side is AI. And so, AI, fintech would be the other route that the UK could take. But in order to be credible on the AI side, you then need to have the whole data center policy, energy policy, the whole bundle of policies together. So again, it's a tough ask for the UK to do that.
Okay, Bilal Hafeez, CEO of Hive. Great to have you with us round the table this morning. Still standing by that 140 call on euro dollar, I like to see.
Yeah, it feels like we're a long way away from that, but we can keep playing the sound, basically, I think is the main takeaway from this.
A wrong clock is always right at some stage.
We can just add to it. That doesn't look like a clock to me. OK, what have we got coming up, Lizzie?
We have got more on Japan's political uncertainty. All these rising concerns about the fiscal policy weighing on the yen. We're going to be speaking to Peter Kinsella, Global Head of FX Strategy over at UBP. That conversation coming up next as we look at the yen at 147 per dollar. This is Bloomberg.
Welcome back. This is the opening trade, 30 minutes from the start of cash trading here in Europe. And the futures picture looks negative. It was a curious session in the US yesterday. Yes, we closed at a new record high, but we closed substantially weaker than we were during the session. And so some of that late in the day weakness stateside we need to factor into European markets. So European stock futures look a little bit negative this morning, Guy.
Let's talk about bonds. Yesterday, big move. We're unwinding a little bit of that. So European bonds go a little higher this morning, not by much. Germany, Italy, France, all just tracking a little bit to the upside at the moment. We're going to await the arrival of the gilt market at 8 o'clock. This on the back of some of the data we've seen out this morning. UK government borrowing certainly coming in worse than anticipated in June. Another piece of bad news for Rachel Reeves, the Chancellor of the Exchequer. It could be bad news for everybody because taxes probably are likely to rise as a result of the data that we are currently seeing. There is a hole to fill, it seems, in the autumn budget. How she achieves filling that hole, we wait and watch with interest, Lizzie.
Well, staying in the bond market, of course, we were waiting for the belated market reaction to the Japanese election over the weekend. At the long end of the curve, you're looking at yields ever so slightly higher on JGBs. But, the big story is that the Prime Minister, Shigeru Ishiba, has vowed to prioritise a trade deal with the US as he seeks to regain his political footing after that historic election defeat for his party in the upper house. Now, for more, let's bring in our Bloomberg opinion columnist, Garode Reedy, who joins us now. Are you surprised by the market reaction that we've seen so far, and how likely do you think it is that we'll get a Japanese trade deal off the back of the weakness that we're now seeing for the ruling Prime Minister?
Well, first of all, in terms of the market reaction, I think largely the results were, even though they were very bad for the Prime Minister and for his party, they were largely what we were expecting, if not even a little bit better than some of the expectations going in to the election. So I think that's not too surprising. There's really a lot of uncertainty right now about where things are going to go, so I would suspect that investors are playing a little game of wait and see how things are going to shake out, because right now we don't know. In terms of getting a trade deal, I am not particularly confident at this point in time. I thought initially, when 3 months ago this all kind of kicked off, that Japan would be one of the first countries off the rack to get a good deal with the US. That hasn't happened. I haven't really seen anything in recent weeks that suggests that Prime Minister Ishiba is going to be the person who's going to be able to bridge the gap with what the US seems to expect and what Japan is able to deliver.
Garoid, what can we expect in terms of fiscal developments in Japan as a result of this election? I know that the finance minister has been out overnight saying that a sales tax cut would be inappropriate, and that goes to the heart of some of the market's worries about fiscal sustainability. Moody's pointing out the risk of fiscal expansion with this particular political outcome. What are you hearing?
It's definitely, it's very hard to say, I think, right at this point in time. Realistically, we don't know who the leader of the government is going to be a month from now, 3 months from now, 6 months from now. So that's, the huge uncertainty that's lying over this. As you say, the position that Ishiba and his party have in Parliament now as a result of this, another election defeat for Prime Minister Ishiba has led them to a position where they might have to start talking about the sales tax cut that a lot of the opposition parties are pushing for, whether that's temporary or not. I believe that the current administration will try to resist that, but will they be able to actually get any of their policies through? Will they be able to get, the budget through going forward if they don't start to bend on some of the policies that the opposition parties want? So all of that creates a lot of uncertainty over, the potential for expansion.
Garoid, thank you very much. Bloomberg opinion columnist Garoid Reedy with the latest out of Japan on the Japanese political developments. Let us take that conversation a little bit further, get a perspective on the yen. Peter Kinsella joins us, Global Head of Forex Strategy at Union Bancaire Privée, UBP. Thank you very much for joining us, Peter. So let's stick with the yen then. I mean, we've seen the yen gained yesterday, but has lost a bit of ground this morning. Stocks have been pretty mixed. Long-end bond yields have gone higher. So what do you think is the overall market conclusion? Or is it, as Garoid was saying, just too early to say what this means?
I think it's definitely too early to say. I think really if we look at Japanese politics, they've kind of realised what everybody else in the US and the Eurozone realised in the last year or two. Inflation is politically toxic, right? And it destroys every sort of incumbent government or coalition. And so really what we're seeing now is the government, raising this idea of a tax cut in order to reduce inflation. That kind of relieves pressure on the BOJ to raise rates. That's the idea, at least. I think the BOJ, for its part, likely to raise rates in October. I think that becomes a lot more likely now. But even at that, that basically takes the depo rate from 50 basis points to 75. We've already priced in about 16 bips by year end. It's not that big of a deal. And I really struggle to see the BOJ getting beyond 1% on the deposit rate. So for me, I saw yesterday, many strategists coming out and saying, okay, let's get long yen, sell dollar yen now. I don't really think it's going to be a big runner. One of the reasons being that it's already very heavily positioned on the long yen side. So sure, we might see a little bit of short-term yen appreciation. You might see 145, but I really struggle to see an aggressive down move in the short term.
So the BOJ, there is some hiking, but not very much, as you've set out. On the other side of that dollar yen trade, then there's the dollar. So if you're not convinced with the go long yen trade, is that because you don't really see so much upside for the yen, or is it about dollar weakness? You don't see much more of the dollar weakness to come?
I think indeed we could see a bit more dollar weakness. I mean, I know you had Bilal on earlier talking about 140 in euro, which is a big shout. But there are good reasons to see a weaker dollar, right? We've seen the peak in short-term rates in the US. We're seeing a decline in US real interest rates. That's clear. And we've also got a steepening at the long end of the curve. Typically or historically, when the Fed cuts rates in the context of steepening long end yields, that's bad news for the greenback. And I think this time will be no different. We add to that the fact that the Trump administration is certainly adding political uncertainty vis-a-vis the Fed and the pressure on Powell. And that's just not a good environment for the dollar to perform.
Okay. Let's explore that. So you're pretty convinced that the dollar didn't bottom out at the beginning of July?
No. Yeah, definitely not.
Okay,
I think we're set to see more.
Okay. In some ways, you can argue that tariffs are going to be inflationary for the United States and deflationary for the rest of the world. That would imply that US rates stay higher for longer and European rates and the rest of the world rates continue to go lower. That would seem to imply a stronger dollar.
It's really about real interest rates. So if we look at it since April, nominal rate spreads have, the correlation with the dollar has completely collapsed, right? And that's true in G10 across the board. If we look at real rate spreads, what you're seeing is actually an increase in euro real rates and a decline in US real rates. So that, to my mind, is a much stronger sort of driver of dollar from here, and consequently I can see it lower. The second derivative of what you've mentioned is we're seeing rate cuts in the rest of the world. You're also seeing much lower energy prices and oil prices. And that's very stimulative for growth. So if we think about the dollar smile, right, slight deterioration in US data-ish, rest of the world kind of playing catch-up. It's bad news to the dollar historically.
In terms of the flow story, what I'm also seeing, though, is US equity markets beginning to gain traction again. The FOMO trade is back on. People want to put money back to work in the United States. Doesn't that work for the dollar?
It depends on the flow, right? So what we saw in Q1 and early Q2 was certainly an outflow from the States. I think that's quite clear. We're likely to see or have seen slightly lower flow of funds from the Eurozone to the US. That's a big deal. So sure, the equity is doing well for the moment. How much more upside we have with the S&P at 25 PE?
Okay. But if the US equities continue to rally, does that put a floor under the dollar?
I would say no. I would say no. I think it can continue to slide. We're kind of pricing in higher equities because of an assumption of lower rates, right? Which is typically bad news for the dollar.
Yeah, you kind of wonder when there's a dollar weakness point that makes US equities more attractive to foreign investors again, and they want to get in on that FOMO trade. More of an equities question, I grant you. But if we could just go back to the yen bounce. So was that more about Besant piling on to Powell as well than relief about the Japanese election?
I think that's probably part of it. I think that you are definitely seeing a pile on Powell. The issue to remember here, I think, is that legally it's very, very difficult to fire Powell, right? And if Trump could have fired Powell, he would have done so already.
But if he did, we saw this reaction the other day on the speculation and lots of talk about how that was nowhere near what the real reaction would be. What would the real reaction be when it comes to the dollar?
Okay, I think certainly you'd see the dollar weaken a bit. You're likely to see long and yield steepen. The question will be what the next Fed chair or governor will actually say. So he or she, when they come in, will say, okay, look, we're going to cut rates, but this is the limit. So what they'll try to do is truncate the extent of dollar weakness. They'll try to truncate market expectations of further aggressive rate cuts, right? Because if you get to a situation, as you have Erdogan in Turkey and so on, you can see what 10 years of that type of monetary policy interference did to the currency and indeed did to the bond market. So I would suspect that you're likely to see a very quick reaction from whoever the next Fed chair is to really sort of, anchor market expectations.
Do you see, and this might be, weighed on by political pressure, or it might be due to shifts in independent thought. Do you see thoughts at the Fed evolving about whether a rate cut is necessary? What are you seeing in the tea leaves? Because, yes, inflation stays a little higher and there's a lot of expectation that we see pass through, but the timing of that pass through is so uncertain. So are you seeing more reasons to think that the Fed should cut rates, or are you seeing the opposite? No,
I think there are reasons to do so. If we look at the momentum of core CPI, on a 6-month moving average, and you annualize it, that has certainly softened. So there's kind of, if you look at, say, supercore, that's all come off a bit. So there are reasons to say, yeah, the Fed could look through the tariff outlook. However, the problem is then you're getting back to the so-called transitory story. You remember that during the pandemic, right? And so I would say, yeah, 1 or 2 rate cuts by year end, feasible, right? Do we see more than that? I would say it's questionable. But if you listen to the two Kevins, Kevin Hassett and Warsh, they're both talking about rate cuts, and that kind of is telling you the direction of travel.
Is a tariff increase like a VAT hike? Because sometimes economists manage to put VAT increases to one side and say, that's not fundamentally about drivers in the economy. But so should we treat tariffs like that? Some at the Fed have suggested that it should be treated differently to other upward pressures on inflation, but maybe not.
Yeah, I think the idea is that it's a one-off. It's a one-off, right? And therefore not compounding and not sequential. The issue, though, is that if you do bring in tariffs and it raises, in a sense, the cost of doing business in the States, you're effectively saying then we're going to have higher cost domestic production, which of course is somewhat inflationary. So you will see that feed through eventually.
So there must be secondary impact.
There will be a secondary impact, but the problem is we haven't seen this type of scenario in a very, very long time, so it's hard to model.
In his interview with us, Christopher Waller set himself up for that July dissent. Yeah. If he and Michelle Bowman do dissent, can the market just brush that off? I know it's not the consensus, I know it's not the majority view, but does it matter, really?
I think it does, because what you're basically seeing is a gradual creep on the FOMC towards, a decision to cut rates. So it does matter, and I think the tone will matter, because, certainly if we look at it, the data in the States has been okay, some disappointment, but payrolls have held up okay, and thereafter really we'll have to see where we're at. But I think overall they are moving towards a cut. It's just a question of the timing, whether it's September or slightly longer.
Same story with earnings. We wait to see which quarter does it show up. But Peter, great to have you around the table. Peter Kinsella, Global Head of Forex Strategy over at UBP. Nice to have you. We thank you. Coming up on the programme, Lindt boosts its sales forecast for the full year as the chocolate maker battles the surging cocoa prices. We're going to break down the results next as part of our Stocks to Watch. This is Bloomberg.
Probably 13 minutes until the market open here in Europe this morning. Not the most exciting picture out there, I have to say, when it comes to futures right now. We're down by, 2, 3, 4 tenths of 1%. US markets faded a little bit towards the back end of the session after hitting record highs, though.
Yeah. Absolutely. So paint whichever story you prefer out of that session in the United States yesterday. Let's talk about these markets. Our Markets Live executive editor, Mark Cudmore, joins us this morning. Now, Mark, we started this programme talking about what is driving markets, the idea that nothing sticks to stocks, they just keep climbing and climbing. And I cited your comments from last week saying, but at the end of the day, there will be tariffs and the average tariff rate on the US will be higher than it was previously, and stocks still have to price that in. When do we start to see that happen, Mark?
I've been trying to work this. So let's look at the 6-month anniversary of Trump's inauguration and kind of the scorecard. And I think some of the moves make a lot of sense. So obviously we've had a lot of volatility, not surprising. Dollar weakness, not surprising from the camp that I was in. Global stocks doing okay. So global stocks doing, okay through the volatility. Fine, that actually was okay with me. US stocks underperforming makes sense. I'm surprised how resilient US stocks have done, so I'll come back to that. And I think yields ultimately being really volatile, but caught between a mixture of kind of, different drivers means they've net gone nowhere too dramatically. So what happens in the next bit? So I think the dollar downtrend can continue, but it's going to be more volatile for me. We've done the easy bit, we've done the dramatic bit. I continue to think US stocks underperform. I'm a little bit worried we're due another more negative environment for that. So I'm overall remain global stocks will do very well in the next coming years because of the easing of financial conditions from weaker dollar, and I think global growth will be fine. I think AI technology boom, but I continue to think US stocks underperform. But I think that with the tariff deadline coming up, that's going to be more pressing very soon. So I think that's the thing that's going to change things. 2 extra bits. What happens to yields in the second half? I am very, very confused there. Do we play the growth scenario of tariffs, or do we get worried about fiscal concerns, a little bit more dramatic long-end yields? But I don't know where that extra catalyst is there. We've had the big, beautiful bill. We've had the Japanese election. We've had everything that should be the big catalyst for the sell-off, and it's not really gone dramatic yet. So ultimately, I guess the big question is, what happens with tariffs with the private sector? How much of a private sector contraction do we get? That's going to decide what happens to US stocks.
But at the moment, all good. US market cracks on. US economy looks really resilient. Global economy looks really resilient. Nothing sticks. The kind of... How hard is it to shake the narrative of just buy the dip? Once again, it was proved back in April, buy the dip. I'm hearing people talking about waiting for an opportunity to buy the dip. It's coming again, great. Yep, Mark's talking about lots of negatives. They're all going to come through at some point. Fantastic, great. Big opportunity coming up.
I agree. That's the perspective of a bull market. When you've got everyone saying, it's going to be a dip I'm going to buy into, that's a bull market. It's because no one's on the market. And I agree. The institutional market investors are underweight this, and that's quite a bullish factor. So you've got, the only reason you get a big sell-off here is if tariffs are a real negative. And one of the things that we were talking on the show in the last week is that, it seems to me that investors really are in denial that real tariffs are going to stay sustained still. And so
Nobody
I think
believes
the fact that I think that if we do get real tariffs sustained, as I expect we will do, then I do think that'll be a big shock for the private sector. People have delayed reacting because of the uncertainty, and they might delay further. I think one of the things that's changed, one of the things that I got really wrong this year, is there'll be some binary tipping point. I think it's not. I think this is a real slow going story because different sectors react at different points depending on what the tariffs come through. But ultimately, we'll see a private sector contraction, and that will counteract the positive tailwind we're seeing from the fiscal side around the world and the fact that we've got an easier financial conditions from the dollar.
Mark, we've had you 3 minutes, but I want to ask you another question because, look, the one that we're really worried about surely is US-EU, and the mood has changed so much on that front. The prospect of no deal, the Europeans preparing for that, the prospect of retaliation, where would that leave the European market?
I think that's severely problematic, and we know that's where the most tense negotiations are. The problem is, I'm sure I'm like everyone else here, no one feels like want to rush to a decision on what Trump's tariffs will be based on the sound bites. They've been so misleading so far, and that's why we're seeing no reaction in the market yet. You've got to see what's ultimately in place in a month from now. Now, I am in the camp that given Trump's long-term, not just the last few months, for the many years, devotion to tariffs as a policy tool and as a revenue earner, that there will be high tariffs somewhere in some sector, some country. I just don't know which ones. And I think that even the people who believe in tariffs are in that camp. You can't preempt it. You just got to wait. So there's the camp that believes it's all a bluff, it's all taco trade, it's all negotiation, and ultimately no high tariffs, and it'll all be a wonderful world and you also get deals. They're obviously bullish. But even the people who are worried about tariffs, they can't be proactively bearish yet. So that means we're kind of waiting on the sidelines, and I think as we get closer to the deadline, there'll be a little bit more nervousness. But we're not going to see a panic sell-off until we know this for certainty.
OK, Bloomberg's Markets Live Executive Editor Mark Cudmore. And remember, you can get up-to-date analysis from Mark and the rest of the team by going to MLIV Go on your terminal. Let's go from the macro to the micro. Chloe Millet is here with our stocks to watch. Chloe.
Good morning, Lizzie. Let's start with AstraZeneca this morning. So AstraZeneca announced that it was going to spend $50 billion in the US by 2030. This follows other pharmaceutical companies like Roche and Novartis announcing also investments in the US recently, and obviously in the context of Trump planning those tariffs on the pharmaceutical sector. The share price has been a little bit struggling over the last year, down about 2.3%. So we'll see how much of a boost we get at the open from this investment. Moving on to a completely different sector, to chocolate. Lindt raised its organic sales forecast this morning. It's been on a really different trajectory to Barry Callebaut because of different pricing power from those two chocolate makers. So we'll see how much of that we get a boost at the open. However, Lindt it's not completely golden for Lindt. We have 4 sales on the stock and 0 buys at the moment. So we'll see how much that guidance raise really changes the picture there. And then finally, we've got some M&A this morning from Sanofi. Sanofi is buying a biotech company called Vesebio for as much as $1.6 billion. The shares have struggled, down 12% over the last year. So we'll see how much of a lift we get at the open from this brand new M&A.
Excellent. Thank you very much. Chloe Milley with the latest on the stocks that we're watching. There are a host of names there from the pharma sector and beyond. I'm going to talk about food because it's 7:52 in the morning, so why not? Compass Group, catering business, they have upgraded their guidance. So we've seen this is quite a sort of bifurcating earnings story, it seems. We've had an upgrade to guidance from Compass Group this morning. We've had it from Lindt. You know, maybe it's about pricing power. Maybe it's about being in certain sectors where there is maybe some more resilience. There's also a deal to mention. They're buying part of a Dutch catering business called Vermaat from Bridgepoint, but really it's about the upgrade that got me. You know, having the confidence to upgrade guidance at this point is interesting.
Which is interesting because that's where the food price story is coming through. These guys must be seeing quite high input cost inflation right now. The ability to therefore upgrade guidance does imply that they have pricing power, and it's that balance. So Lindt is really interesting. Cocoa prices are really high. We can partly offset that with what is happening on the pricing front. Other companies, AXO, people like that, talking about high rates of inflation. They're having to make cost efficiencies to cover some of that. They can do that also to a certain extent with pricing power. Everybody's dealing with relatively high inflation. How you manage that, whether or not you have pricing power or whether or not you need to take costs out of the business, and how that mix works in terms of the ratios, I think is really interesting. But companies are dealing with it. They're adapting to the scenario of a higher inflation world. Can they continue to do that? Can they sustain that with a more tariff-rich world? I don't know. But at the moment, the earnings picture seems to suggest they can.
But of course, it's not a homogenous story around the world. And Lindt saying that the consumer sentiment is particularly weak in North America, but not so much in Europe. So focus there if you want to have a stronger consumer. Yeah,
it does seem as if we might get some bifurcation then and some divergence amongst these earnings stories. We will certainly continue to monitor those as they come in from North America, from Europe and beyond. Coming up, we'll bring you the opening trade then. We are expecting to see a bit of weakness on the European equity markets this morning. Some of that late in the day negativity that crept into the stock 600 even after and even as it managed to close at a record high. We factor some of that into the start of our trading day this morning. We'll be back with the market open. This is Bloomberg.
Tuesday morning, good morning. Let's talk about where we were yesterday. Bit of a history lesson. And what does it tell us about today? Well, a little bit, maybe, actually. European stocks rallied into the close, actually. This is where we went out. That's where the US markets were at that point. We hit record highs over in the United States on the S&P. The Nasdaq actually did even better. But then we get a little bit of a fade. A little bit of a fade into the close over in the United States. Is that significant? Or is that something we should pay attention to? I don't know. But it's rippling through a little bit, Lizzie, into European futures this morning.
Yeah, it looks like the fade is going to continue today on both sides of the Atlantic, but in Europe, futures pointing much lower than they are stateside, particularly underperformance for the DAX this morning, but much of a muchness really across the continent. Red across the screen, Anna. What are you seeing for stocks to watch?
Yeah, let's talk about some of the companies that are in focus. A couple from the pharmaceutical sector, certainly. So we'll watch out for Sanofi, as we were hearing from Chloe earlier on. They've agreed to buy a UK biotech company. The French drug maker is going to pay $1.15 billion up front with a commitment for potential milestones after that. So we'll watch that one. They do say, though, that this won't have a significant impact on guidance, so we'll limit our expectations perhaps a little bit there. AstraZeneca also in focus. This, as they've said overnight, they've given further details about their commitments to the United States, their willingness to open more production facilities over in the United States. So that's certainly a theme that we are watching, certainly with the pharmaceutical and the prospects of tariffs on that sector hanging over these markets. Will they be August 1st? Will they be much further out into the future? And will they really be 200%? Compass is in focus for us. This is a catering business based in the UK. They've upgraded their guidance this morning, Guy.
Absolutely. The European earnings story is really going to gain a little bit of traction as we work our way through this week. Today, there's a few things that you need to fold in, as Anna's been saying. Still a bit of macro that we need to factor in as well. So let's look at this market open. Time for the opening trade. Let's give you some numbers, give you an idea of what is going on. The FTSE 100 delivering a breezy, what am I looking at? 0.1%, if I'm being optimistic, to the downside. Pessimistic maybe is the right word. There you go. The IBEX is down by 0.2%. We are, as we talked about just a moment ago, maybe pricing in at the latter end, the last few hours of the US session, where we did see a little bit of a fade stateside, but it's not significant. We're down by 0.2%. And again, I've only been back for a couple of days, but we're still in this kind of world where you're not getting big moves, where volatility is still very depressed. VIX is at 16. On a daily basis, you're getting kind kind of relatively small moves. We saw a big move in the bond market yesterday in Europe, but again, not much movement in stocks. They're kind of oscillating a little bit, but not by very much. So let's talk about where we are getting some action. Maybe we do see some in the sector story. Lizzie, what do you got?
Well, we've got more than 3/4 of sectors across the continent in negative territory this morning. So at the bottom of the basket, you've got chemicals, tech, energy, banks not far behind. In the green, you've got basic resources up 0.9%, travel and leisure up 0.2%. These are not big moves, it has to be said, across the entire basket. But when you look at some of these individual names that we were flagging earlier, Akzo Nobel was one with earnings out this morning. The Dutch paint maker, of course, the Dulux maker. It had cut its profit forecast, and those shares down 3.7%. You talk, Hannah, about Sanofi, the French pharmaceutical company, of course, with a bit of M&A. Those shares pretty flat to the upside at this point. Julius Baer came out with results as well, beating on inflows in the first half. Those shares actually up 2.4%. And Lindt, bit of chocolate, let's throw that in. So boosting its organic sales forecast for the full year. But the share's actually down 3.1% at this point.
Yeah, that's an interesting one, isn't it? Those Lindt shares down, despite the fact that they upgraded their guidance. Compass, maybe the market was looking for more. Compass Group is up by 0.4%. They upgraded their guidance, but so it's outperforming, but not by a huge amount. I'm interested that Basic Resources is doing quite so well on a day where the direction of travel is downwards. We seem to be a little more risk off. Yesterday, we saw real stunning outperformance by Basic Resource stocks, up really substantially in session yesterday, and I wonder if we're seeing a bit of a continuation of that. Miners were up by 2.9% in session yesterday, and we do see iron ore prices are a little firmer through the Asia session, so maybe that has something to do with it. But as you say, Lizzie, just a handful of sectors to the upside. But it's interesting, you've got the utilities and healthcare going higher, but also Basic Resources and travel and leisure. It's a complicated market this morning.
I think there is some interest in the stock story here. So in a world where actually most stocks are doing nothing, relatively low vol, you're not getting an awful lot of movement. You are getting some movement on the back of earnings. So maybe earnings does provide something of a catalyst. Alfa Laval out with numbers this morning. Its stock is down by 4.5%. Akzo is down by 4%. Lindt and Sprungli is down by 3.5%. So these are the names that are under pressure this morning as a result of earnings. And they do in some ways dominate. Akzo Nobel down by 4.25%. These are the names that are dominating the downside. So earnings are producing a little bit of kind of volatility. There is some of the stocks there are bouncing around a little bit. Again, on the upside, it's Julius Baer, the biggest percentage gainer on the stock 600, up by 2.7%. So some of these names are rising. Norsk Hydro definitely bouncing around a lot this morning. So you are getting. Earnings are producing some volatility. Yeah, we've got stopped trading on Lindt, I think, because of that volatility. So it was down quite a lot, then bounced, and now down again, and then stopped. It seems like the market taking its time to digest. But that does make you wonder about the rest of the earnings season. Does the rest of the earnings season generate more volatility? In a world where we're trading with kind of a VIX at 16, where there's no vol kind of in the market, where markets are rising by kind of less than a percent on a daily basis.
The past months, we haven't seen those moves over 1%, have we, on the stock 6 on the S&P?
Yeah. Precisely. So maybe as we come out, as we get into earnings, actually the amplitude increases.
So this is the thing that gets people excited.
Maybe I'm looking for things that break us out of this kind of low vol environment, or maybe it is the macro, but maybe it's not. Maybe it is actually what we learn from the single stocks, what they're telling us about inflation and tariffs and pricing power and the consumer. All of that is kind of useful information as to how actually in reality all of these kind of big macro moves are sort of feeding down into the market properly.
Well, let's bring in Hugh Gimber. He's with us around the table, global market strategist at JP Morgan Asset Management, of course. Morning, Hugh. When you're looking at these earnings coming through from different companies, euphemistically referring to tariffs and the uncertainty, for example, that they're navigating, what do you make of what you've heard so far? And is there a point later in the year maybe when you actually expect tariffs to manifest more visibly, both in earnings and in the macro data?
Well, first of all, thanks for having me. Let me split that into two. I think what we've seen from earnings season so far on a backward-looking basis is a set of pretty decent results that has underwhelmed the market. And I think it tells you a lot about expectations coming into this earnings season. The narrative has been expectations are pretty low. Of course, we're going to see beats, but ultimately that's not going to tell us a huge amount about where we're going forward. I think more broadly, the situation we're in is where tariffs are going from the hypothetical to the tangible. And so for much of this summer, it's been very easy for investors to dismiss tariff risk and say, well, where is it in any of the data? Where is it in GDP? Where is it in inflation? And over the past week or so, we've seen the first signs. US inflation last week, really interesting. If it wasn't for a big move in used car prices, I think we would have been talking a lot more about some of the tariff-related pass-through. And so that's where we're spending all of our energy on this earnings season, trying to gauge where the hit from tariffs is going to come through, which, to be clear, it will. We do not believe you can see this magnitude of a change in US trade policy without corporates and consumers feeling some of the pinch.
So does that lack of volatility that Anna's been talking about, you know, the S&P not moving more than 1% up or down in a day, surprise you when you've got that tariff uncertainty, when you've got the threats to the Fed chair as well out there?
So I think the key anchor point here is the solid state of corporate fundamentals that was coming into this shock. So that, for me, removes some of the big downside risks. I think it explains why investors have been willing to look at weakness in the market and say this is now an entry point, because I know actually balance sheets are in good shape and some of those big left tail risks for the economy that were on the table in April have now been taken off. So we can understand the willingness of investors to look through some of this noise, but it's where people are just dismissing the idea that this is actually going to be a meaningful issue where I get really uncomfortable. Because for corporates so far, why would you make a big call about where we're going to head? You look at the last quarter's earnings season, they either said nothing or they said, we'll give you 4 or 5 different scenarios and you can choose your own adventure within it. Yeah. That can only go for so long.
So what breaks what breaks and when this mentality of it's all good? That's what I hear. If a dip's coming, great, fantastic. I love the idea of a dip coming because I can buy. Not a dip's coming because actually there are reasons for that dip to be there.
I think it's the economy, ultimately coming back to the state of the labour market, because one of the key points of corporate resilience is their ability to pass through the pressure that they're under to the consumer. That, I think, is still the main assumption, that margins are starting at such a strong level that corporates are going to just repeat what they've done for the last 3 or 4 years, see the squeeze on input prices and hand that all to the consumer, which today is feasible. If we're in a situation 6 months down the line where the labour market is clearly weakening more quickly, consumers are starting to come under pressure, that's where they're going to start pushing back against some of those price increases. And so there is a muddle-through scenario here, which I think is the base case. Corporates and consumers share out some of this hit, that US trade policy becomes gradually more moderate over time as markets play that critical role in guiding things to a more reasonable place. But the labour market, I think, would be the main challenge to that story.
OK, so the labour market is the place that we start to look to for further detail of how this plays out. How are you playing things, or how are you thinking about August 1st then, Hugh? And because this is the big, from a European perspective, this is the big unknown right now, is what kind of deal Europe will get. Europe, we know, is working on options if there is no deal and what the retaliation might look like. I mean, the start of August could go very differently, couldn't it? In a quiet market, we know weird things happen in quiet markets when many people are not at their desks. And we saw that
time of year.
Yeah, absolutely. We certainly saw that last summer, didn't we?
We did. Hopes for a quiet summer, touch wood. But I mean, August the 1st, we had payrolls as well on that afternoon. Don't forget, we're going to get sort of a confluence of information on that day. From the European perspective, the bottom line is that US exports are too important for them to be able to give up. And I think that is crystal clear when you look at how Europe is thinking of retaliating. It's all political. It's Harley Davidsons, it's Levi Jeans, it's Jack Daniels whiskey. When you think about that from a European perspective, that means that tariff escalation is a much bigger deal for growth than it is for inflation. So that, I think, gives the European Commission some cover because they know they can push some of these political levers in the knowledge that if we see further tariffs escalating, you have the ECB as the backstop. That's where Europe is in a very different position today, where they can afford to cut in the face of tariff escalation in the way that the Federal Reserve can't.
Okay, can I ask about the ECB then, with that in mind? I mean, you think the tariff issue for Europe then, there's deflation involved there? Even though, I mean, is that just in the short term? Because if you step back and think that this deglobalisation might be catching, then that sounds like it could be inflationary more into the medium term. But you focus on maybe the short-term deflation dynamics.
In the short term, yes. We think the hit to growth would overwhelm any of the inflation pressure. Think about China in this as well. China-US trade frictions building. The option for China, therefore, is to move more goods to Europe. lower tariffs and therefore lower prices again for the Eurozone. So in the short run, we absolutely think that for Christine Lagarde, this should be a growth issue, not an inflation issue, and therefore there's room for the ECB to cut further if trade tensions escalate again over the summer. More medium term, of course, we're in a world where inflation is not necessarily going to be higher on average, but it's going to be more volatile. And all of this economic nationalism that we're seeing is leading you to a world where supply-side shocks are going to become more frequent. For investors, I think the key implication there is that you can no longer rely on negative stock-bond correlations consistently. You need to be thinking through all of these shocks about protection against the growth slowdown, but then also protection against the inflation spike.
So what do I do in all of this? I'm sitting here, I've got a little bit of FOMO, markets are doing relatively well, I'm hearing all the risks that you're talking about, I know they're coming, probably, I don't quite know how they're going to hit, it's going to be really uneven, it's going to be really difficult to deduce exactly what's going on. What do I do? Am I still long stocks? Am I still longer European stocks, rest of the world, than I am the United States, despite the fact the US has outperformed over the last kind of 2 or 3 months quite significantly? What am I doing here in terms of just managing a portfolio, given that the universe of risks that seem to be orbiting around me at the moment?
So let me give you 3 things on that. First, I think credit is well positioned, because what I'm talking about in terms of the growth slowdown is an entrenchment of capex. Corporates starting with strong balance sheets and deciding to put off future spending.
You're talking about IG, or are you talking about high yield?
I think both are pretty well
High
positioned.
yield has done really well recently.
It has, but for good reasons, because balance sheets are in good shape. Yes, spreads are tight, but when you think about the all-in yields, you have some room to absorb rising spreads before you're going to see that coming through in negative returns. So yes, I think you will see excess returns from credit, both in IG and high yield, because corporates fundamentally are in decent shape. That would be point number 1. Point number 2, we think there's more room for DM ex-US to outperform the US going forward. That's primarily a capital flow argument, that investors are still looking at the US as a market which is very hard to turn down. Just think about all of the pushback we're now seeing against this European rotation. Big picture, the growth differential between the US and Europe is set to narrow, and that is a big deal for the European earnings story over time. More room for Europe to outperform. And then third, think about currency exposure much more carefully. That means either you diversify your regional equity bucket further, or you need to think about currency hedging, because in Q2, for me, the big story was the dollar continuing to depreciate at a time where other US assets were recovering.
Great to see you. Thanks for stopping by to see us. Really appreciate it. Always. Thank you very much, Hugh. Hugh Gimber, Global Market Strategist, joining us from JP Morgan Asset Management. Call 6 looks like this morning. Remember, we get SAP later on tonight. I think it's out at circa 9 p.m. this evening. So keep an eye on what happens with the tech stocks here in Europe. But the European earnings season really kind of gathers a little bit of momentum Tuesday into Wednesday into Thursday. LVMH, names like that coming out a little later on this week. LVMH, a little softness this morning, but actually broadly quite a bit of softness this morning. Novo is actually rising a little bit. But elsewhere, even Nestle, safe area, sells a bit of chocolate. It's down by 0.3%. Talking of all of this, let's fold in the latest earnings that we're getting. Chloe Melly's here with more.
Good morning, guys. So let's start with a big share move from Lindt this morning. It is down more than 6%. It did raise its organic revenue forecast for the year, but that might have not been enough to really impress the market. So it's really down. That follows a rally in the shares over the last few months. Moving on, we have got some news over from AkzoNobel over in the Netherlands, and it is down 4%. It cuts its profit forecast. Said that it was due to tariff uncertainty and currency headwinds. So we've got a big share move down there, 4%. Now moving on to Compass. So Compass did quite well this morning. It is up it was up 4.5%. It has raised its organic revenue forecast and also made a big acquisition. So that seems to be driving up the stock this morning. And then finally, let's end on some semiconductor movement this morning. So Infineon and SG Micro are both down more than 2% this morning. Their peer over in the US, another semiconductor company, NXP, provided a forecast that kind of disappointed the market a little bit, and there's a read across there with the European chip stocks that are down this morning.
Chloe, thank you very much. Chloe Melly with the latest on some of those stocks on the move. Yeah, weakness coming through in Switzerland then with Lindt and Sprungli and Givaudan all on the back foot. We'll certainly keep an eye on that. We will move on to other earnings stories as well this morning. Coming up, European earnings in focus. Norsk Hydro reporting strong second quarter results. We'll break down the results on this programme as companies continue to navigate trade policy uncertainty. This is Bloomberg.
Let's call it 19 minutes into the equity market trade. This is the picture you're looking at around Europe, fairly flat. Earnings, actually, I think is probably the more dominant theme that we are watching this morning when it comes to the single stock story. And there's plenty of actually really interesting narratives out there. Let's talk about Norsk Hydro, the aluminium producer out of the Nordics. Some really interesting commentary, I think, coming through from the company. The stock is up actually on the back of the beat, but there's you just kind of read through the statement. It's fascinating. Under the current political environment they talk about, investments will focus on flexibility, risk mitigation, and responsiveness to a changing economic and policy conditions. Quite a lot of flexibility here in terms of kind of what they're saying, i.e. we don't know what the policy environment is going to look like. Clearly, this is a company that's going to be impacted potentially by tariffs. Long-term growth remains key, but we're shifting to operational efficiency, cost control, and maintaining optionality. Jonas Ekblom in Stockholm covers this story for us. Look, the company's out with a decent set of numbers. Top line beat, the market kind of likes it. But they are talking about a lot of uncertainty over the near term in terms of what the business is going to be delivering. Just talk us through what they've said to the market this morning and why we're getting this positive response.
Yeah, for sure. No, like Norsk Hydro, like very much similar to other Nordic industrials. They're talking a lot about the tariffs and geopolitical uncertainties and how it's impacting them. And really, it's a lot of them, it's signaling a wait and see approach still. Like a lot of companies are talking about the 10% tariffs on Europe, and most of that has already been mitigated and handled by the companies. And again, like it's very much a wait and see because things change by the day.
As you say, they're handling it. Is that why the stock is up? Is it because there's a confidence that they are handling or will handle the tariff impact well?
Yeah, good reminder on the Microsoft.
Yeah, exactly. I think we've seen some like earnings strength across the board when it comes to how companies are handling the tariff impact. A lot of Nordic currencies have strengthened quite significantly against the US dollar, and that's seen as a more tricky proposition.
Okay, Jonas Ekblom, we thank you so much for that analysis. And we're actually going to be speaking to the CEO of Norsk Hydro following the company's earnings today. That exclusive interview with our very own Tom McKenzie coming up at 9:30 a.m. London time.
Staying with the European earnings theme, let's talk about the Swiss chocolatier Lindt and Sprungli. Shares of this business down by 5%, despite the fact that the company posted strong growth in the first half of 2025, raised its full-year guidance for organic sales growth. So what's happening? For more, let's bring in Bloomberg's Swiss markets reporter, Allegra Catelli. Allegra, very nice to have you on the programme. So what do we note here? What had we missed in focusing on the upgrade to guidance from Lindt and Sprungli?
So thanks for having me. While the results in Europe were quite good, the company actually reduced its margin guidance, and that's what's weighing on the stock this morning. Higher price elasticity, mostly in the US, is being felt by consumers that are worried about tariffs, and that's after Lindt pushed through really steep price increases around 16%. So the lower volumes posted this time around also show the pressure the whole category of chocolate has been feeling for the past 2 years now. Really, really high cocoa future prices have deeply impacted the whole sector. It's also of note that the stock is at record highs, so analysts are a little bit concerned about further upside from here. And this is kind of the first time that the company is flagging any, consumer spending weakness over in the US.
Right. Is there an expectation, Allegra, that maybe actually tariffs will hit this company? We haven't seen it yet in a meaningful way, you could argue, but it's coming and it could get worse. And it does seem as if sort of higher end European luxury companies could be at the sharp end of this story. So what is the tariff read-through, and what are people expecting the tariff read-through to be?
I think it's more of an indirect tariff impact that impacts consumers and makes them go for more value and cheaper alternatives. In fact, Lindt is very much seen as the premium brand within the chocolate industry. It's also been its strength because they see it as a gift-making opportunity, and so consumers would rather splash on this type of brand, but in this type of environment that might change.
Okay. Allegra, thank you very much indeed. Allegra Catelli joining us out of Zurich on what we're seeing in terms of the luxury story and the Swiss luxury chocolate story. I have to say the whole Dubai chocolate thing completely caught me by surprise. Everybody seemed to get very excited about that.
Them and their copycats just everywhere.
Trying to get it was
everywhere.
very difficult. So chocolate became kind of a must-have commodity. I guess normally a must-have commodity, but very much a must-have commodity.
Well, it was really interesting what she was saying there about that pricing power, because we were talking enthusiastically at the beginning of the programme about here's a company that seems to have pricing power. Look, they're guiding higher. But she was very clear there saying, well, look what happened to the margins in the US, though, and that's where they put up their prices really aggressively, and it seemed that the market couldn't absorb it.
Back
there was some
bit.
pushback, yeah.
And that's what they did with really high cocoa prices. So food prices generally are super high at the moment. Cocoa prices have been very high for quite some time and don't seem to be coming down in any kind of meaningful way.
I have to say, just having spent some time in New York, the food prices were extortionate there.
Yeah, they always are, but more extortionate than normal.
Even after a slightly stronger pound than, say, I don't know, 6 months ago. Let's talk about some of the other earnings stories, shall we? I've been diving into the Givaudan numbers, and those, when I saw the headlines cross earlier on this morning, they did seem as if they were light on the sales line and on a host of other lines against market expectations. But you don't get the sense that the management were maybe focused on that when putting together the release, because they were talking about how pleased they were with the continued strong financial performance in the first half, despite, and here's where we get to all the euphemisms for tariffs and everything else. They're talking about despite the environment of ongoing geopolitical and macroeconomic challenges. I mean, there are many of them, aren't there? But when you look at the conclusion of some of the analysts this morning, there seemed to be a focus on two different areas of the business where things are a little light: the well-being unit and the taste unit, because this is a flavours and fragrances business, but maybe it's the flavours part. So again, this is food.
It is food, yeah. I want to talk a little bit about paint. Akzo Nobel, really interesting. So a number of different things kind of around Akzo. As you say, they make Dulux, they make all kinds of things on the coating side. But what they're flagging is the FX story. It's a stronger euro. It's this sort of translation effect that they're talking about. If you sell a lot of stuff in the United States, obviously that is something you have to translate back now.
That is really interesting, because last time we got the earnings conversation with Akzo Nobel, we spoke to the management, and there was a sense that tariffs don't really hurt them because they make heavy stuff. And so you make heavy stuff in the location you're going to sell it. So you make paint for the US in the US. But that ignores then the FX
translation effects.
impact.
The indirect effects.
That
you've got to bring the money back. You've got to bring the dollars back, but you're not getting as many dollars for your euro as you once were. The stronger euro obviously affects that. And it does work in the reverse for United States companies as well. So these big tech companies which make a lot of money outside the States, that translation back into dollars actually works in favour of them.
Goldman Sachs was talking about that being a slight positive, actually, for US stocks.
Exactly. The likes of Invesco, JP Morgan Asset Management saying that this is precisely one of those reasons why you should get in on that stock market rally stateside.
Coming up on the programme, we'll sit with the earnings themes. Earnings season kicks into gear on both sides of the Atlantic. Companies weighing trade uncertainty against broader market concerns, of course. We will talk about some of that tariff impact. This is Bloomberg.
This is the opening trade. We are 30 minutes into today's session, and the Stoxx 600 is down 0.25%. Weakness really across the European continent as we wait for clarity on the trade situation, the no-deal scenario being battered around among EU officials, but also we've got this mixed batch of earnings coming through. So passing that, but a little bit of outperformance for the FTSE, and that perhaps correlates with what you're seeing in the sectoral picture. Best performing sector is basic resources, up 0.8%, Guy.
Yeah, started yesterday, it's kind of continued through into today, but the earnings story I think is really fascinating. I think as the week develops, like we've already had a lot of earnings already, I'm going to get more as this week develops. You're going to get some really big names. You've got SAP tonight. You've got plenty of other big names coming out throughout the rest of the week. But there's some tension within the European earnings story, which I think is really fascinating. These are companies that are struggling with a stronger euro. We could go higher on that. They're struggling with what's happening on the tariff front. They're definitely struggling on the inflation front. How do they manage all of this? The earnings maybe aren't quite as strong as also we're seeing over in the United States. So let's talk more about this. Michael Basica joins us, strategy for EMEA equity markets here at Bloomberg. Is that the picture? I guess the earnings season already starting to almost reinforce the outperformance we've seen of US stocks recently and the underperformance we're seeing over the last kind of few months of European stocks because the earnings picture is not there at the moment, you could argue, to support the European stock picture.
Yes, Guy, that's right. It's the earnings picture is not here. We're very early stage, though. I would give that as a caveat because, things can change. But from what we have seen so far, it's been pretty mixed. Some sectors are really, really doing poorly, like the chemical sector especially.
Which is usually a kind of leading indicator.
Yes, like a canary in the coal mine
exactly.
kind of thing. Yes. The thing is, it's very hard to give a guidance at the moment. And that's all because of the tariff deadline, all because of we don't know what's going to happen. It seems there's a lot of tension going on. We're getting closer to the 1st of August. There's nothing there. Since the US wants to play hardball there, Europe as well. So we might get more tension until we get there. Funny comment this morning from Goldman Sachs trading desk about how the clients have started to actually getting more worried that we don't get a deal by that time.
Oh, right, okay.
Yes, and there's like a hedging demand growing from
How are they doing
clients.
that? What are they hedging?
They're buying puts on the Euro stocks,
right?
And so they literally, and on the DAX as well, they're literally hedging their bets on European stocks because they're kind of worried now we're not going to get something, and Europe could be really vulnerable to a no deal, especially Germany. So that's what we're seeing.
The more I think about the date, August the 1st, the more that just worries me. Just the fact that it's August, Michael. And was it just last year we had all that drama around Japanese rates, and that's where it started, but it quickly morphed into something much bigger because these are periods of time where you don't have everybody at their desks and there's sort of, maybe too many machines in charge. But is that something that worries investors increasingly? Maybe that's also why they're seeing a lot of that activity, that hedging activity at Goldman's.
That's right. August is a month with lower liquidity. It's trickier to trade. It's always more volatile. It's it's not a month where you want to. You want to come in without hedge. And obviously there's these tariff deadlines. There's the rates that are still high in the US. There's inflation creeping up. It's it's getting a bit tricky, and we have seen over the past few weeks there was a lot of complacency from investors, everything is fine, we're going to get a deal, it's okay. But the more we get closer to it, and the more we think, well, maybe it's not that easy, and it's not going to happen, or there'll be an extension or something like that. But worries are creeping up.
So what if everything is fine on August the 1st, and there is an extension? We're still range bound for the S&P. How do you break out of that? What, to ask Guy's question, excites the market to move the S&P more than 1% up in a day?
So on the S&P, it's a slightly different picture. The thing is, positioning on US stocks was so depressed earlier this year. It's been going back up, and you have a very big cohort of systematic strategies that are still not overweight on US stocks. And those systematic strategies, whether it's vol control fund, whether it's CTAs, they're ready to buy a lot more. So as long as you have volatility staying low, like we have now, those funds keep buying the US stock market. And that's why we're seeing, that's why the market is so supported. On the other hand, you have so much support for tech. It's crazy. Crowding indicators for big tech are the highest they've been this year. Nvidia is literally the most crowded stock in the world right now, but it's not the only one. A lot of US tech is the appetite for US tech is just there. It's still there. The AI frenzy is back. So there's a lot of demand there.
What changes the mentality? It feels to me we're still in this kind of mentality that we've been in for years. That a dip is an opportunity, that weakness is to be bought, not sold, that investors are still in that older mentality. April didn't change anything in terms of people's perception, and that's why they continue to see risk is almost a good thing. if some of these risks materialise, why is that a bad thing? It creates an opportunity to buy. So, yeah, people are hedging the downside risk at the moment, but is there still that mentality of any weakness is an opportunity, any weakness is to be bought?
Well, at the moment, that's what we're seeing. The thing is, earnings growth is still okay, especially in the US.
Yep.
We're expecting 8% this year, 11 or 12% next year. AI is supposed to feed into productivity numbers. So, growth is there. There's no other place where investors want to be than in equities. And so buying the dip is kind of the mentality still.
Michael, you mentioned chemicals as being one area of concern, and you said it's very clear early in the earnings story, so we don't have all of the details. But are there any other sort of nuggets? We've been throwing around a few things that stood out to us, companies upgrading guidance. Some of them, that sticks and they do well. Others, they upgrade guidance and still the stock falls. Are there things in the earnings picture that have really stood out to you anecdotally?
The auto sector is interesting. We've seen Renault and Stellantis pretty bad guidance, pretty bad earnings. At the same time, it's kind of people were expecting it. It's priced in. We see a lot of rotation into the former laggards of the European market, especially whether it's mining stock or autos. So there's investors are not too fussed about that. They kind of expected all those.
That auto weakness.
Yes,
it's certainly a well-trodden story. A story we picked up on many times.
Oh, yeah. And it's really interesting to listen to what's happening in China about the fact that the Chinese are talking about the fact there's so much overcapacity and they want to pull it back in, but they're also talking about it from an AI point of view as well. Over-investment in that space. That mentality definitely not being represented over in the United States. Michael, great stuff. Thank you very much indeed. Senior Strategist for EMEA Equity Markets, Michael Masika. Definitely worth a read on a daily basis of the stuff that comes out of that team. European leaders, Lizzie, what are they up to?
Well, they're travelling to Asia, Guy, this week to meet their Japanese and Chinese counterparts, it should be said, for trade and defence talks. Now, there are high expectations here that the meetings in Tokyo are going to yield defence and trade cooperation, which really is in contrast with the hopes for discussions with Beijing, which the hopes for are limited. For more, let's speak to Bloomberg's Oliver Crook. He's back in Berlin for us. Ollie, just talk us through the differing relations that the EU has with Japan on the one hand and China on the other.
Yeah, ahead of this trip from Ursula von der Leyen and the President of the European Council, Antonio Costa, who are going first to Tokyo and then to Beijing. As you mentioned there, Lizzie, it's really going to be very sort of contrasting in terms of tonally and in terms of what they hope to achieve with one another. The trip to Japan is really about sort of reassuring and shoring up kind of reliable partners that Europe has in the world. There are fewer of them today than there were a year ago, right? And that is largely because the United States has withdrawn in many ways from the international multilateral order and has really distanced itself from Europe. And really there's an opportunity here in Japan for the Europeans to sort of build on this relationship on defense, on commerce. One of the other things that they want to talk about is the support for multilateralism and international rules-based system, a system that the United States is moving away from. And you also had earlier in the year, early in June, the first ever Japan-EU security defense dialogue. That is, again, a new innovation in order to try to build up that relationship going forward. That will contrast to the next day in Beijing on Thursday, where you'll have the meetings again of Ursula von der Leyen, Antonio Costa, with a number of officials over in China. And really, when you look at what they've laid out on the agenda, even publicly, it's a lot more muted, right? They want to underline the importance the EU attaches to fair and balanced relationship with China. You know, overall, there's been very universal complaints about China's trade practices all across Europe. There are some European states that want to see people see the bloc getting closer to China. That is not really a predominant theme, though, from most of the leaders within Europe. And of course, the other sort of issue is the sort of geopolitical challenges. Of course, China kind of on the other side of the Ukraine-Russia conflict. One place where they may have a little bit of overlap is on this idea of sort of climate change. But there again, the Europeans are going to be very threatened by the Chinese, who have really taken a massive lead in all things sort of climate practices, whether it's solar panels or EVs. And that is something that is going to be really top of the agenda in terms of their concern in dealing with China.
OK, so Ollie, that's a sort of look ahead to later this week, where we'll be very focused on that Europe-Asia relationship. In the run-up to August 1st, and who knows when we get news, we're also focused on the possibility of a US-EU trade deal. Talks seem to be ongoing. How vulnerable, you're in Germany, I mean, how vulnerable are Germany's plans to Trump's trade war. Post the invasion of Ukraine, actually, we saw that parts of the German manufacturing base so damaged by those higher operating costs that they suddenly had to endure. And then we see this on top, this threat to the export engine. What are you hearing?
Yeah, and we had this really great conversation yesterday with the CEO of Deutsche Bank and Siemens, who gave kind of their appraisal of the trade relationship and the trade talks that are going on for the next 2 weeks. I think really my takeaway, and this was a point that was made by the CEO of Siemens, Roland Busch, was that basically, as you guys were just discussing in the earlier segment, that actually 6 to 12 months of will they, won't they, is actually going to be worse for the private sector than a deal that's maybe not that great. And that they really just need to get this behind them in order for them to make these large investment pledges that they would like to make. In certainly in the era of Merz, where you've seen all this public investment from the German government, you also need to have that private investment, and that private investment is predicated on certainty in the global trade order. There was also another side of this conversation, and this came from the CEO of Deutsche Bank, the silver lining that exists for European banking. Have a listen to what Christian Sewing had to say.
There is one trend which is the same across the world, that our clients want to have a European alternative to the US banks. We have very strong US banks, very capable US banks. But in this world of geopolitical uncertainties, they want to have a capable global European player.
And Deutsche Bank would like to be that global European player. We've heard from Mario Draghi, we've heard from many others about the need for European champions in banking, and Deutsche Bank really wants to position itself in order to be that major player on the global stage. That being said, the challenge ahead is large. When you go back about 20, 25 years, Deutsche Bank was only about half as big, or maybe a third the size of JP Morgan was back then, the biggest bank in the United States. Today, JP Morgan is an $800 billion company, and Deutsche Bank is, 13 times smaller than JP Morgan. So that is sort of the scale of the challenge ahead for some of these businesses, but that is what they'd like to address in this new European Commission, focus on competitiveness, and with this large stimulus package attached from the German government.
Ollie, great stuff. Thank you very much indeed. Ollie Crook joining us out of Berlin. Some great interviews coming through from that Germany Invest session yesterday. Let's talk more about what is happening in the UK right now and try and figure out exactly kind of where we're going. The data this morning are really tough. And it's going to be really interesting to see exactly kind of what we're doing with this. We need to figure this out a bit more. But the gilt market reaction this morning is quite interesting. And I'm fascinated to see exactly how ultimately the gilts are going to be reacting to this.
Yeah, yield higher at the long end, or across the curve actually, in Britain, off the back of these public borrowing figures, billions more than expected because of higher debt costs. It looks like the Chancellor's going to have to raise taxes when it comes to the autumn. Can they get away with that politically? It seems like the UK really in a doom loop here. We'll
talk about it more in just a moment. We'll come back in just a second and deal with A, the data we've had out this morning, and B, what the implications are for the autumn budget and Chancellor Rachel Reeves. We'll do that in just a second. This is Bloomberg.
I'd gently point out that the fiscal headroom we put in the budget was considerably more than the last government put in their last budget by some measure. But then there was a lot of fluctuation in the early part of this year, particularly with conflicts in different parts of the world, but also with the immediate after effects of the tariff decisions that were being taken, for example, in America.
UK Prime Minister Keir Starmer speaking to the liaison committee of the House of Commons yesterday, and some of that volatility he was talking about leading to the government having to borrow more then. So the UK government borrowing by the government came in worse than forecast in June. That is higher than expected, with a surge in debt interest payments sending the budget deficit to £20.7 billion. It's a setback for Chancellor of the Exchequer Rachel Reeves that will fan speculation over potential tax hikes to shore up the public finances. For more, let's bring in Bloomberg's Sam Unstead. And Sam, sometimes we talk about, gilt yields going higher or lower and what this might do to the headroom, and it sort of doesn't matter too much until maybe we have another event where the OBR is going to make another estimate of headroom. But it starts to really matter when it influences the amount of money that it costs the government to service its debt. So what do you make of this announcement this morning then, that the borrowing came in more than forecast, that the budget deficit £20.7 billion, well above what was expected.
Yeah, well above what was expected. And also, so not only interest payments driving it up, but although tax revenue went higher, it was lower than forecast. So that combination is not good for the government. That's not what they would want to see. As far as it goes for gilt markets, we've had, over the course of this year already, a couple of quite idiosyncratic, quite strange blow-ups in the gilt market, where we've had a lot of volatility come through for what appear to be kind of quite vague reasons. This is quite a solid reason for people to get a bit more worried. And as you come round to the budget, I think what you're now facing is a kind of summer where you've got quite low liquidity anyway, and now quite a lot of uncertainty about what may or may not happen when we come round to the autumn statement.
Well, the Prime Minister in that clip was kind of blaming international factors, external factors when it comes to these gilt market sell-offs. But, the last time it came down to, unfortunately, the Chancellor's tears.
Yeah.
Is it possible to see what could, on the horizon, trigger the next gilt market sell-off that's a domestic thing?
Well, I think, so you've got, with the gilt market, both a kind of idiosyncratic UK-related issue with the fiscal outlook here, with the rules, with this kind of constant uncertainty about how much headroom there is. They are right that there has been also international factor, kind of general repricing of bond markets over the course of the last year. But that's not a good thing. Like, that's not something to take as any kind of win or to offer up as an excuse, because the fact is that still sends borrowing costs higher, and the headroom here is weak. The headroom here is nowhere near where they want it to be. So if you've got international factors driving it up, things that are outside of the UK government's control, that's not a good thing.
And
either.
I suppose that's the point of the headroom conversation. I don't remember years ago we didn't used to talk so much about headroom, but the point is, with small headroom, it leaves you more vulnerable to those international dynamics.
That's why it's not a good thing.
And he's saying there that he's left more than the Conservatives did, but it's no more than the Labour Party left the last time. And so is that responsible when you know that you're in an environment where there could be these international headwinds?
So which taxes are going up?
That's the question. Well, no, but that is the question over the course of the next couple of months. So they are going to have to either increase taxes, and probably they will have to do both increase taxes and find more spending cuts. So the likelihood is the next 2 months you're going to get a lot of speculation about where that may or may not be. If they do tax rises, I think the most likely areas you're going to see is things like duty, if you like sin taxes, kind of cigarettes, alcohol, anything like that. But most of it as well would be backloaded. The income tax threshold probably gets frozen again.
Yes.
Yeah, the drag.
I mean, and then we just enter this sort of weird world where one party says that taxes went up and the other party said that they didn't, and it's just based on entirely different definitions of what a tax rise is.
Yeah. And
Save us, Sam.
And then I think the thing that you're also going to continually see, and I've been seeing this more and more from kind of economists and strategists coming across my inbox, is questions about, do they need to change the fiscal rules, right? But with the gilt market where it is, and given the kind of general nervousness and uncertainty, if they were to do that and in any way fumble it, which, let's be honest, could well happen.
They could do that. Yep.
They're more than capable of achieving. Then you could see a really significant move.
Maybe the time to do that is when you're in a position of strength.
Exactly. So you'd be trying to take these rules, which even yesterday they said are ironclad. We're not going to change these rules. You'd be trying to change them at a time when the market really doesn't want you to do it.
Is there a belief that the government is now incapable of driving efficiency and spending? You look at two sides of the ledger. Every time they've tried to create some sort of a saving, it's not happened. They just have an inability to be able to do that. There are so many savings you could make in the UK. There is so much efficiency that could be created.
Yeah.
But this government doesn't seem, or any government doesn't seem to have the capability to deliver upon that.
Yeah, I mean, if we're talking specifically about this government, I mean, the welfare thing showed you exactly how difficult it will be to come after almost any spending cuts at all that in any way will offend one side of the party, right? So they are stuck in this sort of position, the government, where they want to make these cuts, but a big side of the party is going to go against them. Again, they don't want that because that creates more instability, and any instability at the moment for gilt markets is bad. So yeah, they are very much between a rock and a hard place.
Yeah, the language that was used in that session by the Labour Work and Pensions Committee Chair Debbie Abrams about those reform cuts yesterday, saying she was ashamed about it. The politics of the Labour Party is just not going to allow that many more spending cuts.
Efficiency seems to be the way you maybe solve that problem is not by making cuts, by making efficiencies. Cuts and efficiencies are two different things.
It requires investment.
Not if you're a certain Labour, if you're many Labour MPs.
No, if you can deliver the same service with less resources, that is efficiency. And that ultimately, that is where the UK is going to have to go. How do you achieve that You are hearing certain NHS trusts talking about, I can't remember exactly how the structure is now, but they're talking about the idea that maybe actually AI can help in terms of the way you run a hospital. That is the area in which maybe we do need to see help. But again, government's struggling with this.
I grant you, maybe it's a different story if you bring in the word AI, but for many, efficiency and austerity are the same thing. Bloomberg Salmon said, we thank you so much for bringing us all of that latest. Not cheering us up too much, but we'll let you get back to your porridge. Let's tell you what else is coming up on the day book for the rest of the day. At 10 a.m. London time, we get the Bank of England's Andrew Bailey testifying on financial stability. We've got lots of US earnings coming through. GM and Coca-Cola have been reporting before the market opened. 3 p.m. London time, we get US new home sales, a rare bit of eco data this week from the US. And then European earnings coming out as well. ASM International and SAP after the bell as well. But let's bring in Bloomberg's Valerie Teitel for more. Val, what are you watching as a potential catalyst? Because we really need one. We need some excitement at this point.
I think I'm going to be watching the GM earnings, especially just to maybe some beginning color on how the auto industry is dealing with these tariffs. I thought it was very interesting that even though we got this update from Stellantis of a first half loss, shares still ended up in the green. So it's going to be really hard to parse through just what the market is going to be taking away from these warnings on tariffs, from the numbers on tariffs that some of these automakers are speaking about. But GM, out of the U.S. automakers, is one that is more exposed than others to the auto tariffs. So I think what they announced today in their earnings results could be a good guide on what we could perhaps hear from other automakers later this week.
And expectations are quite low. The Stellantis story I thought was quite interesting, especially as a new CEO. What do you do when you're a new CEO? You come in, you kitchen sink the numbers. Precisely. Nice lower base.
It wasn't my fault.
Yeah, we're going to start from down there. We're not going to start from up here. This is where we want to be ultimately in a year, 2 years' time. But yeah, but the market is looking at these numbers that are still coming through, and we're waiting tech. So tech's about to arrive as well. So that's going to be a really big feature of the landscape because it's been such a solid driver of this market as well. I wonder if maybe that's where the wobble comes through. Expectations are quite high again.
Well, we do have Alphabet beginning the Mag 7 on Wednesday, as well as Tesla, but you can maybe count that into the more tariff-exposed sectors. But the one thing about this AI trade is it's not really exposed to tariffs. No. So maybe that can be the thing that can drag the U.S. equity market again to more highs. We know that the AI trade has been a big part of the equity rally this year, and it does seem like a lot of these tech-focused, AI-focused companies aren't afraid to be spending money, to be investing in CapEx. We know that the data center spend, even the energy behind the data centers, there's not a lot of fear in terms of investing for that kind of outcome, for that kind of future.
I'm definitely more nervous about August 1st than I was 2 hours ago when I sat down at this desk, Valerie. So I don't know what achieved that. But
it
all
was
of our
Hugh
conversations
reminding you that payrolls are on the same day.
August 1st, same day. But just like we saw in early July, we have this date, August 1st, but in early July that got moved and fudged, and there were various announcements beforehand that meant that actually July 9th, was not such a big deal.
The market can just basically ignore it up until 24 hours before a dedeadline, and then we start worrying.
Okay.
So maybe it'll be that.
Okay, that makes me feel better. Thank you.
We'll be worrying. We'll be paying attention to it. Valerie, great stuff. Thank you very much indeed. We've got the CEO of Norsk Hydro coming up. It's a really interesting day of corporate earnings. That interview is at 9:30 a.m. Tom's going to be taking you through that interview, plus also the rest of the Pulse. That is up next. Hope you enjoy the show. This is Bloomberg.